Hello, everyone. Thank you for joining me again today for today's discussion. Today, I've been joined by Catherine Stanley from Columbia Threadneedle. How are you doing, Catherine?
Yeah, good, thank you.
Good, good. We'll get cracking in a moment. And today, we're going to talk about the CT Responsible UK Equity Fund. But before we do that, and Catherine gives me an insight into what she does, let me just give you a little background of what we're talking about today and who Columbia Threadneedle are. As you may not know, Good Green Money, we're ethical financial advisors. We provide holistic advice to clients, and as part of that, we'll get involved in building some good quality ethical portfolios. We look for the best ethical, the best responsible funds out there. The CT Responsible UK Equity Fund is a prime example, and Catherine's very kindly agreed to join me today to talk about this. Just to tell you about Columbia Threadneedle, the CT and the CT Responsible UK Equity Income. It's a major US investment business formed in 2015, but the sources of those two businesses, Columbia, UK, big UK institution, Threadneedle, started life in the UK in 1994, came together. Today, it's looks after investments worth over $750 billion. So it's a big player in the industry, employs over 2,000 people all over the world. The CT Responsible UK Equity Fund, it's got an interesting history, particularly for people that are in the ethical investing space. Some would say it's the granddaddy of ethical investing. It started life as the F&C Stewardship Fund. Some of you may know that fund, may remember that fund. Started in 1984, and it grew out of conscientious investors wanting to avoid investing in South Africa when the apartheid regime was in full flow. This fund was created with the purpose of avoiding investment companies that invested there. It's then seen some iterations. It's become the F&C Responsible UK Equity Growth Fund. Then it moved on to the BMO Responsible UK Equity Fund, and then the CT Responsible UK Equity Fund as it is today. I know Catherine's keen to point out, though, that in that long history, it's only had two fund managers. It was first run 25 years by Ted Scott. She's been there since 2009. Catherine Stanley is the Manager Director and Head of Global Small Cap at CT. And yeah, so there you go. There's an insight into what we're talking about today. Catherine, I'll turn to you. Firstly, do add anything I've missed, or if there's anything you want to correct about what I've said. But the other thing I'd love to talk to you about is that you've been managing this fund and in this space for a long time. How do you see the whole responsible investment world? How has it changed since your tenure in 2009?
Yeah, absolutely. No, thank you for that. That sounded, I think that pretty much summed up the history of this. And yes, it is a long history. Yeah, you're quite right to point out things have moved on a lot, certainly since this started and since 2009. It was then, very much ethical investing, and that's a sort of term that doesn't really exist so much anymore. But when I first took this over, it was very much based on product-based exclusions, and those exclusions, as you highlighted, were really based on a sort of set of ethics. After that, really, the whole sector became more known as SRI, or socially responsible investing, the sector, as broader social factors came into play and were taken into account, and we moved away from that sort of ethical investing name, because what are ethics, who decide they are, that didn't really work so well. Came in, and then more really, I would say there are now sort of three other things that I would highlight that have come in the space. The first one would be the environment. Clearly, that's become a much hotter topic in the last few years, and that's become much more of a focus. That wasn't so much of a concern when I first started running these funds, but has become a prime concern for many investors. Now that climate change debate has moved on from being an academic debate to something that's real world, and of pressing concern to investors, to populations, and to governments. So that has come much more into focus. The second of those sort of more recent changes, I would say, is more of a focus on conduct as well as on product. Just a straight quantitative assessment of what a business did and looking at the products that they produced. Now we think much more about conduct as well, and behaviours are much more important. Now that's clearly a much more qualitative approach and a different way of thinking, but that's something that's equally important now that we take into consideration. And the third thing is, when I first started, it was very much a straight exclusion base, and after that it didn't really matter what you did. Here is the list. You've excluded some companies for their products, but after that you run it as a normal portfolio. Whereas now I think these sort of funds are much more interested in looking for companies which have positive, sustainable characteristics, as well as not having any of those products that people are less keen on investing in. So positive sustainability has come into play much more in the last 4 or 5 years as well. Clearly, this space is going to continue to evolve. It's got increasingly complicated, much more sophisticated thinking about these issues. And I think at the moment we're seeing some funds funding which are specialists in some areas, whether that is climate change or oceans, or even on the social side. So it's quite difficult to also prioritize. So that's something we're seeing at the minute. That anticipating we're going to see that change in the next years.
Thank you. That is a very thorough and detailed walkthrough of where things have come to. Yeah, I think you've highlighted a really good issue there about quantitative versus qualitative. Just for anyone that's not aware, quantitative is about hard facts and crunching numbers, more or less. Qualitative is to get under the skin of what a business is doing, or ask some softer facts. Are they led by, conscious management, that type of stuff? And that's become much more important over the years. Yeah, thank you for that. Let's turn a bit more detail to your fund. Looking through your investment mandate, there's a 3-word phrase that you use, which are like avoid, invest, improve. Very simple. Let's drill down a bit more into that. I mean, you've touched upon some of these things already, but tell me more about your avoid, invest, improve strategy, if you may.
Yeah, sure. I mean, that's really the philosophy that underpins all the responsible funds that we have within the SINS range. All those funds that are branded responsible will work in the same way. And the way the process works is that our responsible investment team, not my team, a separate large team that we have, will set the policies behind these responsible funds. And they're very detailed policies, and there's a lot of information on the website about them. And then they will assess companies against those policies to see if they meet or breach them. The reason we do that is because obviously greenwashing is a concern for the sector, and this removes that from my decision making. That's done completely separately without thinking about the investment side of things by people who are experts in that area. So when it comes to avoid, what they're looking at when they assess those companies is businesses that might have damaging sustainable practices that we don't want to be investing in within a responsible portfolio. And if a company fails in either product or conduct on any of their policies, then we will avoid investing in those, and they will be removed from the universe that I can choose from. So out of that process, I end up with a universe of about 220 names that meet all our policies and criteria as decided by our responsible investment team. So then we move on to invest, which is really where my team comes into play. We're looking at those 220 names, and then we're looking for businesses with positive sustainable characteristics and positive investment characteristics as far as possible. So we're assessing on ESG factors. We're very focused on quality, and ESG speaks very much to quality, and also on risk. And again, ESG comes into play there, both a positive or a negative risk for a business. So we're looking then to invest in businesses which meet high quality standards with relatively low risk and positive sustainability characteristics out of that universe that I'm given. And then lastly, the improve piece is really about being responsible shareholders in the fullest sense of the word. So using our ability to both vote and engage with companies to encourage continuous improvement in those businesses. So we don't want businesses to stand still. We want companies to continue taking this very seriously and move on. And that improved pillar involves both my team and the responsible investment team. The responsible investment team are responsible for the voting element, but they would consult with us. And engagement is done both by the responsible investment team and by my team, we're coming from different sort of points of view depending on our relationships with management at the time.
Again, thank you. Very thorough, very detailed there. Yeah, the fact that you've got this separate, absolutely separate responsible investment team that works hand in glove with what you guys do is great. To drill down to 220 stocks out of what's available out there, you're cutting out a lot of the market there, so that's good. You're really just drilling down to the quality stuff. One thing I've noticed about your responsible investment team, they have an independent advisory council, which is there in place to ask the awkward questions. So to have that extra layer of independence, it really adds extra weight to this. So that's a really good insight into your process there. I think what we can do now is to add a little bit of color. Let's move on and we'll give some example investments. You very kindly provided me with a couple of examples of each: and avoid, and invest, and improve. Maybe we could just walk through those. So a couple of examples of companies that you've avoided.
A couple of examples of companies we've avoided. These are sort of fairly clear cut and the sort of things you wouldn't expect sort of portfolios. So BP, an obvious example there. We went fossil fuel free as a part of the philosophy in 2019. So we don't own any businesses which either own fossil fuel assets or extract fossil fuel assets out of the ground. So BP fails. I mean, clearly this is quite an interesting debate because these are big businesses with, yes, legacy businesses that we don't want to invest in, but equally they generate a lot of cash which can be used to support investments in energy transition as well. So I think this is an area that is of debate within the sector, but we avoid them as part of our fossil fuel free policy. Another example would be another obvious one with BAT, tobacco stocks we're not going to be investing in these portfolios, and that would be fairly common across all funds within this space.
Thank you. We'll move on to invest in a second, but yeah, it's interesting that you pick up on BP. I mean, this is an evolving area. The large oil companies are moving down the renewable route, but I think there's going to be a tipping point when most of their revenue has come from renewable energy and there's only a small legacy left. When that tipping point is, we're not sure, but I'm with you completely. Right now, there's just too much that's still related to, fossil fuels to make it viable. But as you say, there are people in the industry that think it's good to encourage them. Right, invest. You've got a couple of great examples. One that I often talk to clients about. But anyway, I want to steal your thunder. Give me a couple of examples of the firms that you've squarely invested in.
So obviously we have a portfolio of somewhere between 60 and 75 names generally. So those are all obviously companies that we've invested in. A good large cap example, very obvious, would be AstraZeneca. Clearly they're of positive benefit to society across the range of pharmaceutical products there, and particularly you probably pick oncology franchise within that. So very strong player. And then this supports exposure to small and mid cap within that. So if I pick a company within that space, an example there would be a business called Genuit, which it used to be called Polypipe. This is an interesting one, I think, because it's a business that designs and manufactures plastic piping systems for drainage, for heating, plumbing, ventilation. And often plastic has got a very bad rap within this space. But in this particular area, plastic is the more sustainable option relative to the alternatives, which are largely copper or cement. And plastic wins both on production, use of energy for production, for transportation, and for disposal. So they are actually using a huge amount of recycled plastic in there as well. They're much lighter to transport, and actually this is the more sustainable of a smaller mid cap that we'd own within the portfolio.
Oh, a couple of great examples there. Yeah, a big player and a more modest-sized one. For some reason, the image of you is frozen on the screen right now, but I think we're okay to keep persevering if you're okay with that. But I can still hear you. Absolutely fine. Let's move on to.
Sorry about that. I can still see you moving, but
oh, you just started moving again. Oh, look at that. Let's move on to the improvers. Improvers. This is particularly interesting. Yeah. Okay. I'll zip. You tell me about improvers.
Yeah, so these are companies that we would engage with, and again, I'll give you an example of a large cap company where the engagement would be done by our investment team through their annual program of engagement that they would run. An example there would be Tesco's. So there is a lot of engagement that goes on with Tesco's, as you might imagine, but most recently the conversation with them been around supply chain, for example, in tea plantations in Kenya, those sort of areas, to see how Tesco's is managing that sort of situation. And go to home and payment of living wages, and will Tesco sign up to a living wage standard? So that would be a programme of engagement led by the responsible investment team. Again, if I then focus on one that maybe is more falls within the area of my investment team to engage with, we do much more engagement within the smaller mid-cap parts of the portfolio where we have very close relationships with management teams there. And an example there would be a company called RPS. This is an environmental consultancy, and it has a strong net zero offer to its customers, and it clearly has great positive sustainability characteristics within its services that it offers. It went a week on its own internal ESG disclosures and reporting, despite the fact that its own activities were very, very strong. We did there to encourage better disclosure, to encourage them to do more within their own business. And we were very happy with the progress that was being made there. But very recently, that has been subject to a bid approach by another much larger consulting business that also has a focus on environmental consultancy. So we look to be shortly about to lose that one from the portfolio.
Oh, well, there you go. You've still done the right thing, moving in the right direction. And yeah, I think when you see companies that are open to engagement, that's a real insight to how they are culturally, and a culture of a business to be a decent business is so important. So yeah, really good examples. Okay, we'll move on a little bit now. I'm going to play devil's advocate, if I may, for those cynics out there that don't believe in responsible investing. Who are they, these strange people? But some may say you've got this big universe, you've cut down quite sizably, you're missing out on potential returns. What about all the people, all the companies that are outside of your world? Why should we still invest with you?
I absolutely with that, which are successful businesses and profitable companies, but that's not the fund that we are. In an absolute prime example at the minute, we're clearly missing out on owning companies like DP and Shell, which in this very volatile world that we live in at the moment are doing very well. And they're very profitable businesses, but yes, we're missing out at the moment because they don't fit within our responsible philosophy. We're very clear with clients about what we do and what we're investing in, and if people want to own a mandate that doesn't have those sort of responsible constraints around it, then there's plenty of them to choose from. But we think we can offer a very strong portfolio of high quality businesses where you can sleep at night because they're also doing good things. And I'm a firm believer, to your point earlier, that there is a strong correlation between companies which have strong ESG credentials and also being high quality businesses. Those two things go very much together, and particularly management teams that are very open to both engagement and also embedding ESG and sustainability within their business. They tend to be very good businesses. So that's what you're really sort of getting with us. And it is something that you need to take a long-term view. We're not looking to maximise the profitability or performance of the portfolio on any sort of 1 month or three month basis. We're looking for businesses that we can own over long periods and see them grow, because we believe that these trends are structural over the medium term.
That's great. It's funny enough. That's the topic I often talk to clients that come through door, and they say, how do your portfolios perform compared to conventional, and swings in our oil prices and think long term is the one example I always pick up upon. And culturally as well, if you've got a really good culture, there is the argument that you'll retain staff, you won't have to retrain them, you'll have loyal customers, you don't have to advertise them much. So there are some real bonuses to acting this way. But not one final point is, as well, as you touched upon earlier, the climate crisis has become so critical now, as we know. If you're not engineering your operations so that they take account of that, that's just wrong financially, ignoring anything else. So, I think this is the future.
Yes,
Okay, I think this has been a brilliant conversation. Thank you for your time today. Before I just close things off, do you think there's anything else that you might want to mention that we've not covered today, or do you think we've covered most things?
I think we've covered a lot of key points. I suppose the only other things I would mention is that this portfolio does climate change seriously, and we are signing up to be which effectively means that by 2030 we're committed to decarbonising the portfolio by 50%. Relative to the benchmark in terms of financed emissions. So that's a challenging target. So that's something that we're taking very seriously. And the other thing I would mention is just for people who are interested more in income, we do have an income version of this product as well for people for whom that's relevant.
Yeah, no, absolutely. I mean, today we're talking about the growth fund, looking at the long-term performance of this fund. Since fruition, it's done very well. But if you're not in the know, you get different orientations of funds. Some that pay out good dividends if you want to live on those, or whatever, or some that go down the growth route. And thank you for highlighting that. Again, thanks for your time today, Catherine. Anyone that's watching this, a couple of things to wrap up. Remember, this is for information only. Don't jump in and invest without financial advice. Come to us. Talk to a good green money advisor or one of the other responsible advice firms out there. There's lots of us. And if you like what you see, subscribe on our YouTube channel, and every time new content comes up, you'll be able to know about it. Thanks again, Catherine. That's been excellent. I know you're a very busy person, so I do appreciate your time today, and I will see you again.
Lovely. Thank you very much.